We just finished going through STMicroelectronics 2026 Q2 earnings call materials, and now we want to sit down and share what we found. Here's the puzzle for you. The company beat on revenue, beat on earnings, and actually raised its guidance, and the stock dropped 13%, right? A beat, an upgrade, and a crash all in one morning. So let me walk you through this one slowly, the way I'd explain it to someone sitting across the table, because the story underneath is a lot more interesting than the headline. According to the report, Q2 revenue came in at 3.49 billion, beating the 3.43 billion estimate, and earnings per share hit 0.31, well past the 0.25 the street was looking for. And here's the one that should stop you. The company says net income flipped from negative 97 million a year ago to positive 282 million now. Think about that, from bleeding red to real profit. So why did the stock get taken to the woodshed, down 13% before the bell? The filing spells it out. The market sees the operational turnaround. It's not blind, but it's terrified by delayed manufacturing restructuring and gross margins that just sat there flat. Our take is simple, and I'm maybe 80% on this. The numbers said we're back, and the market said back at what cost and when. So that gap right there, that's the whole video. Before we go further, you've got to know what this company actually is, because most people don't. The report frames it as the invisible giant, and they're not the name on the AI chip everyone's screaming about. According to the company, the moat is in process manufacturing and deep customer integration, sitting inside three worlds: your car, the factory floor, and your phone. Here's the thing, they don't build the giant AI GPU. They build the countless little essential chips wrapped around it, the ones nobody notices until they're missing. And the filing flags three highest growth pieces: silicon photonics, smart power and sensors, and silicon carbide. Let me put it plainly, this is a picks and shovels business. To be fair, the bears would say invisible also means weak pricing power. Our read is the opposite. When you're designed into the car and the factory line, you are very hard to rip out, and I'm fairly confident on that one. Now, this is the page that gets me a little excited, so let me slow down. The company calls it the optical triple play, and it ties right into the AI build-out. Picture the optical transceiver module, the little part that shuttles data around inside an AI data center. The report says they own three key slots inside it: the MCU, their market dominant control unit, the electronic IC, their proprietary BiCMOS signal processing, and the silicon photonics piece that does the optoelectronic integration. 3 slots in one module, that's the triple effect, and it scales with a jump to 800G and 1.6T speeds. According to the company, this data center line does more than 1 billion in 2026 and far exceeds 2 billion in 2027. Our take, and I'll grade myself at 70% here, this is the cleanest selling shovels in the gold rush story in the whole deck. They don't need to win the AI chip, they just need the traffic to keep growing. Alright, back to the money, cause talk is cheap and cash isn't. The report lays out 3 receipts. Net income from negative 97 million to positive 222 million, real profit on the board. Free cash flow from negative 152 million to positive 75 million, which the company calls cash health restored. And inventory days walking down from 166 a year ago to 140 last quarter to 126 now, sitting below channel targets. Why does that last one matter? When inventory is bloated, everybody stops ordering and works down what they've already got. So inventory coming down, that's the channel clearing, and orders coming back. The filing also notes gross margin reached 34.8%, up 130 basis points year over year, and calls it the decisive end of the inventory digestion phase. I'll read, and I'm fairly confident here, the demand side of this story is genuinely healthy. Hold that thought, because the next few pages are where it gets complicated. So where's the growth actually coming from? The company says all 3 engines are firing at once. Automotive up 14% quarter on quarter and 16% year on year, driven by smart power sensors and the NXP MEMS integration. Industrial up 20% sequentially and a big 34% year on year, as general MCUs and analog pull together while channel inventory clears. And comm and computer up 13% quarter on quarter but 50% year on year, propelled by that AI optical boom we just talked about. Now, here's the number that made me sit up. So the report puts the book-to-bill ratio at roughly 2.0. Do the math yourself. That means for every $1 they ship, $2 of new orders come in, and total backlog 4.5 to 5 quarters of visibility. To be fair, book-to-bill can run hot when customers double, order in a shortage. But our take, order coverage this deep is not nothing. The demand here is real. This is the page that supposedly should have sent the stock up, not down. The company raised the bar. Q3 guidance 3.7 billion, give or take 35%. That's 6.2% sequential growth with margins targeted around 37%. And the Q4 target 4 billion with second half growth that blows past the normal 15% seasonality. Then they stretch the vision way out, the data center line topping 1 billion in 2026 with orders already 100% covered, more than 2 billion in 2027 and 18 billion long-term model by 2028. Big, beautiful numbers. But look at the corner of the page, and this part matters. It's stamped unrealized targets, and that's the company's own word. So the pitch is enormous. I'll read, and here's where I get careful. A target you haven't hit yet is a promise, not a receipt. The market clearly decided to price the promise, not celebrate it, and we'll come back to why. Okay, here's the heart of it, the root cause. For years, this company lived by a simple rule the report spells out. Hit 4 billion in revenue, and you get 40% gross margins. That was the historical promise. So now revenue's marching right up to that 4 billion milestone. But look where margins actually are, 34.8% in Q2, 37 almost percent in Q3. The report literally labels the space between the two lines the gap of concern, and that gap is the whole problem. And remember the setup, the stock was up 154% year to date coming into this, price for perfection. So when the market realized a massive multi-year manufacturing overhaul is going to hold margins down even while revenue sets records, it hit the sell button hard. Our take, and I'm 75% here, the panic wasn't irrational. When you've already paid for 40% margins in the stock price, being told not yet, wait until 2027, that genuinely hurts. So what exactly is holding those margins down? The report does a clean autopsy, and it's two anchors. First, 60 basis points of restructuring cost from closing tooled fabs and shifting from 200 mm to 300 mm silicon and from 6-inch to 8-inch silicon carbide. Second, 70 basis points of underloading, meaning idle capacity and technical transfer delays while they retool. Add those up and that's your drag all the way to a 40% margin destination they don't reach until the end of 2027. And here's the key line. The company says the CFO confirmed that hitting 4 billion in revenue is no longer enough by itself. The 40% model needs the restructuring finish first. Let me translate that plainly because it matters. This is self-inflicted. It's an internal supply transition, not a demand problem. To be fair to management, that's actually the better kind of pain because you control it. But our red self-inflicted still bleeds the P&L for 2 more years. Let me put the two sides right next to each other because this is the referee moment. Management's pitch, straight from the deck, the turnaround is absolute. Net income and free cash flow both fully positive. The AI data center is an unstoppable new engine pushing well beyond 2027, and demand is accelerating with clear visibility out to 5 quarters. Now the market's reality and our take alongside it, the revenue targets. Honestly, highly credible, backed by hard order coverage, we don't argue with those. But the actual goal, the margin realization, is held hostage until late 2027. So near term, investors are handed improving but slow margins guaranteed. Here's the honest summary, and I want to be fair to both sides. Management is offering a genuinely brilliant long-term vision, but they explicitly tied profitability to a 3-year construction timeline. And the stock right now is pricing in the wait. Nobody's lying here, they're just standing on different ends of the calendar. You can learn a lot from what the analysts kept hammering on the call, so let's read the room. The report tracks 3 topics. Margins, asked 3+ times. Everyone wanted the realistic path back to 40%. Management stance. The report tags it conditional, neutral. So they firmly pushed that realization out to post-2027 and tied it to finishing the restructuring, no wiggle room. Second, AI data centers, also asked 3+ times on growth durability into 2027, and here the stance is graded highly positive. The company confidently defended the 2 billion plus target and that 100G WAMP 60 triple effect. Third, capacity tightness, asked twice on general MCU bottlenecks, and the stance is positive and resolving. They're ramping the Crolls fab to 15,000 wafers a week and finishing at grade 300 nanometer by 2028. Read the pattern with me. Confident on demand, confident on capacity, but deliberately cautious, almost defensive on margins. That's not an accident. That tells you where management itself feels the risk. Now let me flag the risks the way I'd flag them for you before you put a dime in, and the report lists 4. Number 1, top priority, restructuring drag, underloading technology transfers, and mask rework costs suppressing margins all the way to 2027. Number 2, the valuation baseline. The stock up 154% year to date and 127% in just 6 months before this print. That's priced for perfection, and perfection is fragile. Number 3, legacy analog bottlenecks. Delays ramping the old analog lines mean they can't capture 100% of the demand sitting right in front of them. And number 4, cash burn mechanics. Capital spending of 2 to 2 billion, plus a freshly issued 1.5 billion convertible bond. I'll read and I'll be blunt. Risks 1 and 2 are the ones that bite. The expansion is real, but it's burning cash today for a payoff in 2027. So that's a long time to ask a richly priced stock to sit still. Step back with me and look at the whole bet, because this is really one big idea. The company is straddling 2 cycles at once. On one side, the old legacy semiconductor recovery, inventory, clearing, auto and industrial coming back. And on the other side, the new AI supercycle, the optical transceivers and silicon photonics. And the report calls the plan a bridge. Here's the picture I'd use, and I'll own that it's my picture, not theirs. It's like closing your kitchen for a full remodel while promising the dinner crowd you'll still serve every single night. The AI data center revenue is supposed to keep the top line fed through a painful, multi-year manufacturing surgery so that margins can, in their words, explosively release at the end of 2027. That's the whole thesis in one sentence. If the bridge holds, it's beautiful. Our take, and I'm honest at maybe 60%, the demand end of the bridge looks solid. It's the construction timeline in the middle I'd be watching. So what do we actually watch over the next 12 months? The report gives 5 KPIs, and these matter more than the daily stock price, so write them down. 1, the gross margin slope. Does Q4 finally lift above that Q3 37%, and do the underloading costs start to fall? 2, data center realization. Are the 2026 billion and 2026 income is holding, and is silicon photonics ran on schedule? 3, the restructuring timelines. Are the 200 mm to 300 mm and 6 to 8 inch transitions hitting that 2027 deadline? Because that is the literal key to 40% margins. 4, general MCU capacity. Is the A-grade 300 build out and the China supply chain easing delivery lead times? And 5, personal electronics drag. Is that soft spot expanding, or is the legacy analog ramp finally catching up? Watch these 5, not the ticker. And if the margin line turns before 2027, this whole story re-rates. Alright, last thing, radar always leaves you a light. Weighing the whole deck, the business, the backlog, the AI optical story against the price and that margin weight. I'm calling this one yellow. And let me be straight about why. The turnaround is flat, out real. The demand is real. The backlog is real. It's the price that already ate a 154% run. And the margins that management themselves told you are stuck until the end of 2027. Good business. Tough timing on the entry. Here's my caveat, and I'll say it up front so you can hold me to it. If Q4 gross margin lifts off that 37% and the underloading costs start rolling over on schedule, I flip this to green, and I'll admit I was too cautious. But at this price, asking you to wait 2 years for the payoff, I'm watching, not buying. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.